Hey everyone, welcome to today's Explainer. I'm Steve. Listen up because we are digging straight into a major midweek reality check on the tape. Now, if you've been watching the screens at all today, you already know the market just threw a heavy punch. But look, my job here isn't to just read you the news. Anyone can do that. My job is to break down the underlying structure of what's actually happening out there so you can trade it. Let's cut right through the noise and get to work.
The market threw a heavy punch. Let's look past the noise. If you want razor-sharp analysis of this sudden trend shakeout, you've absolutely got to dismiss the mainstream panic. Turn off the TV. You need to track the real, structural data. Because when everyone else is out there letting macro ghosts scare them out of a perfectly good winning tape, we open the ledger. We look at the actual math.
So let's open up that ledger right now and talk about this technical reset.
Let's just acknowledge the elephant in the room here. That record-breaking equity expansion we've been riding, it hit a hard roadblock today. Institutional profit-taking has seriously accelerated, and we need to see exactly where the chips fell. And man, we are seeing red prints across the entire spectrum. S&P futures down over 0.5%, settling right at 7,567. Spot gold fell back to 4,465. Bitcoin took a massive beating, unraveling below key structural levels to print at 65,214 amid some really deep retail capitulation. Even Brent crude took a 1.62% hit. Honestly, it looks like a total bloodbath if you're just glancing at the colors on the screen.
But here is where you have to be smarter than the retail crowd. The real story, it's not the red ink. It's the massive macro release valve taking place right now in the energy pits. I actually want you to pivot your attention entirely away from the equity carnage for a second. The hidden structural movement, the thing dictating the next big play, is happening in oil.
Which brings us to our hidden catalyst, the energy curve collapse.
Look, if you don't understand the energy curve right now, you are trading completely blind. Look closely at the July Brent crude contract. It has completely broken down, dropping right down to the close at 91.89. All that paper premium that had been propping up the energy sector for weeks, it is leaked entirely out. The geopolitical premium is fading fast, and the technical breakdown is just crystal clear on the tape.
And this brilliantly illustrates a key macro concept we always talk about. Downside expansion in crude is a vital piece of correct analysis. Why? Well, think about it. When oil drops like this, it eases input costs across the board. It effectively acts as a massive corporate tax cut. It dramatically expands the profit margins for all those companies sitting inside the S&P 500 indexes. So when you put that all together, what do we actually have here? The fact that oil is falling while the S&P 500 experiences a relatively mild pullback tells us something incredibly important. This is a healthy, mechanical backtest of the market's levels. It is not a structural economic collapse. Keep that in your back pocket when the headlines start screaming at you tomorrow morning.
Now we also have to deal with the yield pressure reality.
Over on the fixed income desk, the weight of interest rates finally caught up today. Long-end U.S. Treasury yields caught a strong bid. Why? Because sticky structural inflation concerns simply refuse to back down. They're hanging around. And here is the golden rule of the ledger. When the risk-free rate refuses to cool off, it forces a mechanical repricing of equity risk premiums, meaning stocks literally have to drop to become attractive again relative to those yields. Everything adjusts to that fixed income rate.
Which leads us to this harsh reality. Mega-cap tech cannot hide from borrowing costs forever. Sure, they can hide for a while on pure earnings power, but on a macro day like today, institutional managers, they look at an overextended index, they look at a restrictive Federal Reserve, and they make the cold, hard choice to just lock in their paper profits rather than fight the Fed. That is exactly what drove the tape today.
So what we have on our hands now is a classic rotation battle, bulls versus bears.
This sudden reversal sets up a brutal turf war. Capital is playing a high-stakes game of defense right now. Let's weigh the two sides of this ledger. The bulls, they're treating this as a routine backtest of a powerful structural uptrend. They're betting that those deep corporate margins, helped out by that big drop in energy we talked about, will result in major dip buying the exact moment headlines stabilize. But look at the bears. They are pointing directly to the extreme fear readings in crypto, the sticky inflation numbers, and an accelerating institutional exodus out of risk assets and into macro safety blocks. They see this as the precise moment the momentum trade finally cracks.
All right, let's cut the theory and get down to professional trading directives.
How do we actually navigate this sudden shakeout without losing our heads? It's time to cut through the emotion and get your marching orders. Listen carefully here. Notice the price action on the S&P futures. Despite all the panic, it is holding right around our immediate line in the sand at 75.67. The structure is battered, yeah, but it is not broken.
And the reason it's not broken comes down to this number right here, 50. I am talking about the upward-sloping 50-day exponential moving average. That line is our structural anchor. As long as that 50 EMA holds on a weekly closing basis, the primary bull engine is structurally protected. Period. End of story.
So here is your checklist, the exact directives you need to follow tomorrow. Number 1, trade the hard levels in front of you. Stop guessing. Number 2, keep your eyes pinned to that July Brent contract at 91.89. If those outer months track lower, equity bulls absolutely have the green light. Number 3, respect the moving averages. They are your anchors in a storm. And number 4, strictly manage your position sizing. Capital preservation is priority number 1 in a volatile tape. I'm going to leave you with my most crucial directive. Stop guessing tops and bottoms. Seriously, let the numbers dictate your execution. Do not let macro ghosts and scary headlines dictate your book. You trade the actual mathematical numbers right in front of you. Because the ledger doesn't wait for latecomers, and the market sure doesn't care about your feelings. You've got the data now. You've got the structural breakdown. You've got the levels. Now the only question that matters is this: are you ready for the morning bell? I'll see you in the pits. Stay sharp out there.